Hey, what's up everybody, and welcome to another video for the Keystone Financial Academy. My name is Elliot, and today we're going to cover everything you need to know to fully understand credit and credit scores. Before we start, be sure to subscribe so you don't miss any of the upcoming financial investing topics. And if you enjoyed this video and find it useful, please do hit the like button right below. Okay, so let's talk about credit. First, let's get a few definitions out of the way. Your credit, of course, is your ability to borrow money or buy goods or services with the understanding that you're going to pay the debt back at a later time. Now, the terms credit rating, credit score, and credit worthiness all mean essentially the same thing. They're all simply judgments about how you repaid your debts in the past, how you're going to handle credit in the present, and what kind of credit and lending risk you are in the future going forward. So maybe worth asking, who should care about their credit and why? The answer to the who part of the question is really anybody who ever had a reason to borrow money. Now, as to why you should care, here are three major reasons. The first reason is that regardless of income, for the most part, there's going to come a point in your life where you're going to need to borrow money, whether it's for a car or for a mortgage for a house or to pay for school, higher education, and so on and so forth. Even if you make good money, you can buy certain things in cash, like for example a car, you still may need to borrow money to get something bigger like a house. The second reason has to do with investing. Even if you're a high earner and have lots of cash saved, you don't always want to use cash when it comes to investing in something like real estate. Instead, you should borrow money and use the concept of leverage. So in these first two examples, it's important to have good credit and a good credit score, not only so you can have additional credit given to you, but also you can save money when credit is given to you by paying a lower interest rate. So you basically are saving money when borrowing money. Now, of course, lenders look at a lot more than just the raw credit score. They're going to look at your income, your current levels of debt before deciding to extend more credit to you. But the bottom line is you need good credit and credit score, both for personal and investing reasons, no matter your income level. Finally, the third reason has to do with the fact that whether you like it or not, your credit will very likely be checked by that job you're applying for, landlord if you're renting, or even by insurance companies or utility companies. More and more credit and credit score is being used as a judge of character, fair or not, and that's why it pays to keep it as high as possible. Okay, with that in mind, let's get into the details. The first thing that needs to be mentioned is there's two types of credit, revolving and installment. Revolving credit is your typical credit card. It's called revolving because the amount constantly changes as you charge more on it, pay it off, or interest accrues. Revolving credit requires a minimum monthly payment all the way up to and including the full amount that's owed, and it's a huge part of your credit score. Installment credit refers to installment loans, and those are pretty much everything except the credit cards, so that includes car loans, mortgage, student loan payments, and etc., etc. Installment credit is also a huge part of your credit and credit score. The next thing to discuss are the credit reporting agencies, or CRAs. There are three main agencies to know about: Experian, TransUnion, and Equifax. Their job is to collect, maintain, and sell consumer credit information. CRAs collect information on pretty much any adult with any kind of credit history. The information comes in from any company or any lender that the individual might have dealt with, and also includes employment info and relevant public records. Alright, now for the part everyone wants to know about, the credit scores. First of all, keep in mind that credit score and credit report are related but two separate items. The credit report is simply a collection of all your debt data compiled by the CRAs. The credit score is an actual judgment of your credit worthiness reflected in a 3-digit number. There are actually two credit scoring models in use, the FICO and the Vantage Score. They're compiled by two different companies or sets of companies, but they really serve the same exact purpose, and that is to assess credit risk. We'll cover each separately to get the full picture. FICO stands for Fair Isaac Corporation, which is the company that created this scoring system, and it's the more common one in use. Its scoring range goes from 300 to 850. Now, what's important here is how the score is calculated and what goes in it. If you know how it's built, you can then fix it if it needs fixing. So here's how the FICO score is broken down by categories. The first category is your payment history, and it carries a weight of 35%. And this refers to your history of paying both your revolving and your installment debt on time. Your credit report will show if you're 30, 60, or 90 or more days late, and that will immediately be reflected in your credit score. This category category doesn't account for the actual amounts owed, only the on-time payment history. The second category is your accounts owed, and that has a 30% weight. This refers to the actual amount owed on each installment or revolving debt account. Now, for revolving accounts such as credit cards, what's important is not exactly how much you owe, but how much you owe compared to how much credit you have on that credit card. This is called the credit utilization ratio. And for example, if you have a card with a $10,000 limit and you owe $5,000 on it, your credit utilization ratio is 50%. This ratio is going to be a pretty big factor when later on we talk about how to fix your credit score. All right, the third category is your length of credit history, and that counts for 15%. And this refers to how long the longest account has been opened, as well as the age of the newest account. Obviously, having a longer track record of accounts and credit will raise your score. The fourth category is your credit mix, which carries a 10% weight. This refers to different types of credit that you have or have had in the past. This demonstrates the ability to handle multiple different debt types, such as mortgage, car loan, student loan, credit card, etc., etc. The more varied the mix, the better. The fifth category is your new credit, and that also carries a 10% weight. This refers to recently opened accounts, and if you have many attempts or actual opened recent accounts, that's a bit of a red flag because creditors think you're desperately trying to seek additional credit. Here are the same weights in the pie chart, and as you can see, the two most important items are how well you pay your debts on time and how much of a credit balance you have. So with all that in mind, what FICO score are considered poor, average, or good? Here's a breakdown from the bottom up. 580 and below is considered poor credit. This generally describes a risky borrower who is subprime, who will qualify for very high interest rates only, or will be declined credit outright. 580 to 669 is considered fair credit. Many lenders will approve loans, but the borrower will pay a subprime rate. 670 to 739 is considered good credit, and this is actually where most people in the United States hang out, where the national average is around 703. Most lenders here will approve loans with pretty good rates. 740 to 799 is considered very good credit, and most lenders will approve the loan and give you fairly good, if not the best rates. And finally, 800 to 850 is considered excellent credit, where lenders will approve almost all loans with the best possible rates. Now, it was mentioned earlier that there's a second credit scoring system. It's called Vantage Score, and it's put out by Experian, TransUnion, and Equifax, basically the big three CRAs, and it is a competitor to FICO. It measures essentially the same thing, but there are now 6 instead of 5 categories, and their weights a little bit differently, as you can see up here. The biggest weighted category here, similar to FICO, is the payment history at 40%, with utilization and depth of credit or credit mix about equal at 20-21%, and that is the biggest difference between Vantage Score and FICO. There are some advantages to Vantage Score, such as it takes less time to establish it, but for the most part it's the same as FICO, and as of lately it's got the same scale, 300 to 850. So the final major topic to discuss is managing your credit, and this should be a proactive activity. So every time you go and get credit for a car loan or something like that, you're thinking, how will that help me maintain and raise my credit score? There are 4 items to focus on here: establishing, maintaining, monitoring, and protecting your credit. Number 1, establishing credit, of course, assumes that you haven't yet done so. For example, maybe you're still in college or you're still in high school, 18, 17, and you haven't really established any kind of credit history at all. What you have to do in that case is basically open up a few accounts. For example, if you need a car, instead of paying for it in cash, you go out and get a car loan. You also get a credit card, hopefully with a low credit limit that you can afford to pay off every time. Even if you have to get a cosigner, these sorts of revolving and installment credits will really help you out is to establish your credit in the first place and maintain it if you pay off everything on time. Maintaining credit just means keeping an eye on the 2 heaviest categories in each of the credit scoring systems. In practice, you really need to do just 2 main things here: make your payments on time and maintain a good credit utilization ratio, preferably below 25%. That means, as before, if you have a $10,000 credit limit, you want your actual balance to be less than $2,500 or 25%. Ideally, of course, the best amount is 0. Monitoring your credit means keeping an eye on it, which in practice is checking up on it once per year. You can do that with all 3 CRAs, and the website that allows you to do it for free is called annualcreditreport.com. I'll put it right up here, and it allows you to go in once per year and check your credit for free. You can do it more often, but you'll end up paying for it. When you look it over, make sure there are no inaccuracies that have crept in, because they do occasionally appear. And while you're there, you can get your credit score. You sometimes have to pay for that, but that is more of a curiosity. What's really important is your credit report itself. Also, you can get your credit score from a lot of credit cards that offer this service as one of their benefits. Item number 4, protecting your credit, refers to the 2 items that are the biggest danger to your credit, and they're somewhat outside of your control. First item is inaccurately reported information, and we can deal with that by going in once per year and checking up on the credit, as just discussed. Number 2 is identity theft. This is a much bigger problem, and I've dedicated an entire video to dealing with this, how to prevent it, and what to do if you are a victim of identity theft. Alright, so those are the basics of credit and credit scores. I'll make a companion video to this one that will focus just on credit repair, because we haven't really discussed it here, and as I just mentioned, I'll make a companion video just for identity theft. As always, be sure to subscribe so you don't miss any upcoming topics, and if you liked this video and found it useful and enjoyable, please hit the like button and comment down below on what you'd like to see me discuss more of. Thank you, and I'll see you guys soon.